Gold prices are trading above the $4,700 barrier as geopolitical risks rotated from Middle East escalation hedges all the way towards the Eurozone, where we have rising tariff threats from the US over the acquisition of Greenland. Hello, everyone. This is Razan Hilal, market analyst with Forex.com. Today is January 2026. Feel free to pause the video and read the following 15-second disclaimer before we go over key levels, defining gold's steep advance from both a momentum and price perspective. So analyzing the gold chart from a monthly time frame perspective to have a cleaner context view given the exponential rally from both the price and momentum perspective. Current price action is hovering above the 4,700 mark in line with increasing global having demand due to rising tariff threats between the US and the EU, which if we do manage to have persistent geopolitical risks in the headlines, then we might have or we might expect the persistence of the exponential surge on both gold and silver charts. Now, given the gold charts currently eyeing the upper bound of a duplicated channel respective between 2016 and 2025, aligning with the $5,000 handle, the midzone of that duplicated channel represents a defining barrier between long-term bullish and bearish bias, which aligns with the $4,000 handle. Now, short-term levels, before we go down there, if we do manage to have a clean hold below at the 4,500 level and the 4,400 level, we might be on our way to revisit the $4,000 handle in line with extreme momentum conditions, with the relative strength index indicator tracing overbought levels at 94.90, which are historical highs. The steep conditions over here warrant caution for any steep pullbacks in both momentum and price perspectives. Should price reject the $5,000 handle, or should we have notable certainty across the markets decreasing the exponential surge in having demand that we are currently seeing. Now, a clean hold below the midzone of that respected duplicated channel and the $4,000 handle is expected to extend drawdown risks all the way down towards the lower border of that duplicated channel, which connects consecutive higher highs between July 2016 and August 2020, which is near the 3,700 to the 3,500 level, which was a previous resistance zone to approximately 5 months across 2025 for potential dip buying opportunities before we have a possible, before we resume the overall primary uptrend on the gold chart. Given the sensitive interplay between geopolitical headlines and haven trends, careful risk management is warranted with focus on high time frame levels amid elevated volatility risks.